subject to only 15% tax rate because of the carried interest loophole. That's not even considered regular income, even though it is. In summer of '98, Russia declared a moratorium on foreign currency payments, which was a euphemism for we have no money to pay dollar or euro denominated debt. When stuff like that happens, there is typically a flight to quality in the markets. US dollar assets are in more demand, more liquid assets are in more demand. For example, yesterday when the stock market was tanking, the bond markets was actually thriving, but the new bonds were thriving a lot more than the old bonds. Suddenly, that spread reversed, it was actually negative. If you're losing 10 basis points, you don't worry about it too much. But if you leverage yourself 100 times, you worry about it. Had Fed not intervened and saved them, the entire US banking industry would have collapsed. Why? Because somebody's funding that position. Citibank, Chase, what have you. If long-term capital management can't refund that because they were based on weekly or overnight repos, uh, Chase and JP Morgan would have gone down. If that happens, you would think that Great Depression was a picnic. But stuff like that happens. There is a reason for that premium. Sometimes that's lack of liquidity creates issues. All right, there's also interest rate risk. I'm going to kind of do this relatively quickly. As you know, longer maturity, higher interest rate risk, which means everything else being same, as an investor, I'm going to demand a compensation to hold a 30-year bond compared to a 5-year bond. Yes, longer maturity, higher interest rate risk. We talked about it last class. If you have a 1-year bond, if the overall interest rates goes up by 10 basis points, sure, you're going to lose some value, but it's going to be relatively minimal. But if you have a 30-year bond, roughly speaking, you're going to lose 1.5% of the value. With a 1-year bond, you would lose about less than 0.1%. So the risk, if you're holding the bond, is higher the longer the maturity. Well, if I'm going to hold one or the other, and if you're giving me exactly the same yield, again, everything else being same, I don't expect any default. I don't have issues with liquidity. I expect inflation to be exactly the same. Then I'm going to ask, okay, higher return, please. Of course, you have the inflation risk premium. If you expect the inflation rate is going to be relatively high in the short term, you're going to demand a more of a compensation in the short term compared to longer term. And we also have something called taxability premium. Taxable bonds have to pay more on pre-tax terms than the non-taxable bonds. That's why U.S. Treasury yields are a lot higher than muni yields. All these kind of contribute to what moves the yield curve around. So let's kind of talk about this. This is time. This is the nominal yield. Let's start with the real version. Again, let's assume at this point, the only thing different between different maturities are the maturity only. So if I did a real yield curve, it would look something like that. There is higher interest rate risk. If you did a chart of the TIPS yields over time, it would look something like that. Because inflation is a non-issue, because you're talking about real. There's not too much liquidity differential. Taxability is exactly the same, and they're not going to be defaulted. So investors require more compensation for longer term. I mean, let's kind of see that out there. For example, U.S. 5 year 5 year TIPS is yielding 144. Okay, in real terms. 10 years, of course, there is no 100 year. 158. You can only get 5, 10, and 30 in CNBC. 30-year TIPS is 192. So compared to 5 years, market wants a compensation of about half a percentage point to hold the 30-year. Why? That's much riskier. How much that premium is also varies over time, but that's one reason behind the shape of the yield curve. So if market expected that inflation rate is going to be stable, whatever it may be, you would expect yield curve to be upward sloping. That's general. Why? Because on top of this, I'm going to add something like this. This differential. That differential may be constant, may be upward sloping. It varies over time. On top of that, I'm going to add something like liquidity. And the order of what you're adding is immaterial. On top of that, maybe I'm going to add something like default risk premium. If you want, you could also add a curve for what you want to call taxability premium. But usually I wouldn't compare the yield curves of taxables versus non-taxables. If I'm going to do that, I'll do them on an after-tax basis. What sort of shapes you could expect? We already mentioned. If inflation is expected to be relatively constant, you will expect the yield curve to be upward sloping. I'll give you an example from Japan. There's not anybody in Japan expecting inflation to change too much in the future. That blue curve is what the yield curve was a year ago. Black curve, what it is now. It is upward slope. Okay. The rate at which that slope is, it depends on expectations. But this basically says Japanese investors or investors in Japanese bonds are expecting inflation to be either stable or somewhat increasing in the future. In those cases, yield curve is going to be upward sloping. On the other hand, let's look at Germania, or as the French call it, Alemania. Currently, until about 3 years, it's kind of humped after that upward sloping. That means in the short term, market is expecting the inflation is either to be a little bit higher or somewhat stable because upward sloping. Then they expect inflation to start coming down somewhere between 1 to 5 years. because typically inflation and short-term interest rates are also highly correlated. And let's look at US. I mean, last year, 1 year rate was about 550, 30-year rate was about 475. That is an example of so-called inverted yield curve. Sometimes some market participants view that as a sign that there's going to be a recession within 2 years. Maybe, we'll see. But at a minimum, it's a sign that market is expecting a slowdown. But this also says we're expecting the short-term interest rates and inflation to come down. It just happened that it did. Right now, it's inverted in the short term, which means until about 3 years, 3 to 5 years, market is expecting short-term interest rates and or inflation to be lower. After that, things are going to be stable, and it's upward sloping. In fact, if you look at the CME Fed Watch tool, inflation or short-term interest rates are expected to come down by at least 2 percentage points. But if you expect inflation to come down, go up in the short term, but go down later, it's going to be hump shape, right? Let's stop there. Remember, next Monday we have Jeopardy on Chapter 6. Next Wednesday we have the first midterm based on 2, 3, and 6. I'm going to post the problem videos and stuff later this afternoon, including the lecture videos if you missed any lectures.